Good evening, everyone. Welcome to Business Live. Coming up in this bulletin, cost of borrowing and interest rates expected to decline this month following a marginal drop in the Ghana reference rate to 15.6% in January. But how soon should businesses and households realistically expect commercial banks to pass on these reductions? We shall be telling you. Also in this bulletin, IC Research projects Ghana's economy to expand by 5.7% in 2025, outperforming the IMF's forecast for the same period. We'll be discussing this with an economist shortly. Plus, growing refusal by traders to accept Ghana coins is creating daily financial stress for revenue collectors and disrupting small transactions in local markets.
Pure water people, those selling pure water at Malata, they don't collect. Those selling at Malata, they don't collect. But they give it to me. If they collect, they will give it to me and tell me that I'm working at the revenue office. So I'll send it to the bank. But if you send to the bank reject it back. They give us back these coins because it's Ghana money.
We have details of these and more for you. Please stay on. Hello again, welcome to the program. I am Pius Kojobaka. Looking at our stories, the cost of borrowing and interest paid on existing loans could decline marginally from today following a reduction in the Ghana reference rate. The key benchmark used by banks to set lending rates dropped to 15.6% in January. More in this report.
In December last year, the Ghana reference rate, which acts as a benchmark for the determination of interest rates charged by commercial banks, stood at 15.9%. This was coming after the Bank of Ghana cut its policy rate to 18% and Treasury bills rate going down marginally last year. However, for this month of January 2026, the Ghana reference rate has been reduced by just under 1% to this new level of 15.6%. The development should go a long way to impact on fresh loans that will be secured by businesses and individuals for this month, as commercial banks are expected to adjust their interest rates due to the changes in the Ghana reference rate. It could also affect persons that negotiated their loans with their banks at variable rates. This should mean that the cost of servicing that loan could also go down. However, individuals that negotiated their loans at the fixed rate may not witness any changes or review when it comes to the cost of servicing that loan. The commercial banks have also indicated that they will move fast to adjust their interest rates once the Ghana reference rate is reviewed downwards.
A senior finance lecturer at the University of Ghana Business School, Dr. Benjamin Amoah, joins us via Zoom for us to have this conversation. Thank you so much, sir, for making time to join us here on Business Live. And a happy new year to you as well, and good to see you. It's been a while. Now, with the Ghana reference rate declining marginally to 15.68%, we are learning, how soon should businesses and households expect commercial banks to pass on these reductions in the form of lower lending rates?
Thank you very much, and Happy New Year to you and your team. How soon, from information I'm gathering, means that it's going to be effective from today. What it means is that if you contact your bank for a loan facility and you are successful, you should see the new rate being applied in calculating the rate at which you are going to borrow. So it is as immediate as one can imagine. Of course, those who have already contracted loan facilities, if the loan, like your news bulletin said, was fixed, they do not benefit from this rate decline. On the other hand, if the credit facility was sourced at a floating rate, then they stand a chance of benefiting from this decline in rate. But in terms of when, it is immediate, and I think if you should go to the bank for a loan facility now, you should benefit from the decline in rate.
All right. So for customers on variable rate loans, what level of adjustment should they expect following the January review of the reference rate? And how much discretion really do banks have in applying the new benchmark?
I didn't get your question clearly, but I should think that you are asking about how much of rate decline should borrowers expect.
Especially for customers on variable rate loans, what level of adjustment should they expect?
Yeah, I believe in the loan contract, there will be a clear definition as to what variable will trigger the loan rate review. So once that particular element in the loan document is identified, the borrowers who are on the variable rate loan will then have to look at how that particular anchor has moved and by how much has that anchor moved. And once that anchor has moved or declined, their rate will also decline accordingly. This particular rate is a marginal decline. So one is not expecting a huge decline in the loan rate. That is if you're on a variable rate loan. But that notwithstanding, if you're a business and you are borrowing in huge sums, even a 0.01% decline in loan rate means a lot for you. So irrespective of the rate decline, it still means a lot for borrowers who are borrowing. I would like to move the argument a bit further. Why are we not talking about the MOMO borrowers, those who borrow mobile money? Are we not seeing this rate decline? And if it's not so, what is Bank of Ghana also doing in this same regime? Because you are going through a period of rate decline. So one will also expect that the MOMO credit providers will also replicate this rate decline. After all, it's credit. So one expects that there should be a wholeness or a seemingly decline in rate when it comes to MOMO or what you call MTN credit facility. That is also hinged on interest rate. We also expect to see some decline if it is not taking place.
All right, let's shift focus to some other areas we want to follow up on that. Despite easing inflation and, of course, declining money market yields, many businesses still report tight credit conditions. Really, what is constraining banks' ability to expand lending at this stage?
Thank you very much. Once you are going through a period of rate decline, there is all possibility that the demand for loan will increase. And the demand for loan will increase because any individual or any business that thinks that they have come across a good business idea would like to pursue a loan request. Now, this loan request will mean that the bank will be inundated with a lot of loan requests. You can't just dish out the loans because you want to make money. You want to be careful. At this point in time, what the banks are also looking at is how do we get good quality borrowers? Because good quality borrowers is very important in a period where you are having rate decline. Without the good quality borrowers, you are going to create loan portfolios and your loan portfolio will not perform. We are already in a regime where the central bank has been complaining about non-performing loans. And so one expects that although the rates are declining, banks in their quest to give out loans should also be careful. So if the business is complaining of not having access to loan, the business must also reassess itself and look at how the business itself looks in terms of how presentable the business proposal is and how much risk that business is posing to the bank. If the business is a good business, definitely the bank will consider providing the credit facility.
That's fine. Dr. Amoah, quite recently, we heard the governor expressed a goal of reducing lending rates to about 10% over the medium term. From the banking industry's perspective, what key conditions must be met for this target to be achievable, you would say?
Yeah, again, we need for a policy of this nature, an intention of this nature, it has to be solely driven by the central bank, and the central bank will have to work on the monetary policy rate work on TB rates. And of course, rates have been declining. So if you look at what we have experienced last year, if we should continue on the same trajectory, supported by an improvement in non-performing loans, very, very important. If we only have a reversal in bad credit, where we are going to have good performing loans, then it makes sense for rates to decline. Because as the rate declines, we will all go for loans. But the question is, are we good borrowers? So we need to also look at how we can manage the demand that will come as a result of the rate decline and the quality of the banks to create and manage the good loans, supported, of course, by the central bank's monetary policy and a conducive credit culture and credit environment.
Like you said, rates are gradually declining. So how much are banks balancing the support or the need to support economic recovery by managing credit risk and protecting financial sector stability?
Yeah, for banks, in fact, the first thing that will hit banks is a reduction in their net interest margin. That is a worry to banks, but they have to consider it. Again, banks will have to look at how best they can also create the loans, because you are intermediating and you cannot sit with the depositors' funds. You have to turn the money around. Banks will have to look at that, and banks will also have to try as much as possible to look into the economy and to look at productive sectors.
It seems senior finance lecturer at the University of Ghana Business School, Dr. Benjamin Amoah's line is frozen. So you were making a point on that. We lost you briefly on that.
I'm saying that banks will have to look at the sectors within the economy that are performing and then consider extending more credit to these sectors. Areas that are difficult in terms of managing credit, the banks will have to shy away from and then keep the little that they can make from the low-yielding investment that we have in the economy.
Dr. Benjamin Amoah, thank you so much for your time here on Business Live. Always a delight speaking to you. Now, let's shift focus to some other stories we are following up for you. Ghana's economy is projected to have expanded by 5.7% plus or minus 0.5 percentage points in 2025. And this will be higher than the International Monetary Fund's forecast of 4% GDP and, of course, 4.3% by the World Bank. We have more for you in this report. According to IC Research, a leading market research firm, festivities-related spending in Q4 of 2025 boosted household and private sector consumption, supporting trades, manufacturing, transport, and information communication technology, while crops remain resilient. IC Research said it, however, expects construction growth to remain normalized below the double-digit expansion posted in the final quarter of 2024, although it sees prospects for recovery above the momentum in the third quarter of 2025. It continued that recovering household spending, driven by stable prices and a softer value-added tax regime in 2026, will support sales revenue and gross margin, highlighting effective distribution networks and efficient management of stock-keeping unit will retain customer base and structurally support top-line momentum. The report said the main investment thesis rests on capital growth than attractive income generation capacity. Ghana's overall real GDP grew by 5.5% year-on-year in the third quarter of 2025, easing from 7% last year. However, underlying activity remained firm, with non-oil growth at 6.8%. Let's analyze this projection further. Joining us via Zoom to discuss this is Wilson Elom Jilevu. He's an economic and fixed income analyst at Data Bank Research. Wilson, thank you so much for making time to join us here on Business Live. IC Research predicts GDP growth of about 5.7% for 2025, above the IMF and, of course, the World Bank's forecast. What do you make of this projection?
Thank you very much, Pius, for this question, and good evening to your viewers. First and foremost, we must acknowledge the fact that the 4% set by the IMF was quite conservative in my view, and also the government also set a target of, I think, 4% by year and median growth of 4%, and that is also a conservative view. If you look at some of the policies that have been implemented, such as the removal of some taxes, it has stimulated consumption to some extent, although wages have not yet adjusted to the current price level. it has the easing of these taxes have allowed some level of demand on the market, or has improved purchasing power on the market. And I think that is what IC is trying to say, that would then mean that inventories would boost, and that would then mean that revenue margins would improve further in 2025. That should then mean that production should improve across sectors, especially the manufacturing sectors. So we should see growth cross the 4% level by the end of 2025 on the back of some of these policies that were implemented in the early part of the year. I do all acknowledge the fact that industry sector has lagged behind because of the procedural hold up when it comes to construction and all that. But nonetheless, 2026 should tell a different story considering the budget that has been allocated for the expansion of roads and bridges. So basically, we should cross 4% considering the stimulus that we are seeing in terms of purchasing power, and that should mean that we should expect more positive outcome in 2026.
All right, Wilson. So for you, how significant is the role of household spending in supporting growth, and to what extent will the stable inflation and, of course, the softer VAT regime we are seeing strengthen consumer demand?
It's one of the major factors in the economy. So if you look at microeconomics, you're looking at households and firms. So if households don't have the purchasing power to consume, you have one side of the economy that is falling apart. And it's one of the major components of the entire economy chain. So you have when you have household consumption improving significantly, that would then mean that there will be more money in the system, or there will be more incentive to produce more on the part of producers. So it plays a very critical part in the entire value chain. But nonetheless, as I said, wages have not yet fully adjusted. Unemployment is still quite at a very elevated level. And we are hopeful that some of the policies that have been proposed by the government should come into fruition in 2026, and that should help boost household consumption to a certain level. If that is not done, then we should still see some lackluster consumption on the market.
And I see research suggesting that the investment case in Ghana, for example, is more about capital growth than income generation, which of course you've alluded to. But what does this mean in terms of practical terms for investors in equities and fixed income? Okay,
so in terms of practical terms for equities and fixed income, if there's more money in the system, that means that households will have money, some surplus to invest or to give, to save. And if there's no, in other words, if there's some kind of liquidity constraint on the market, it means that people will not set aside some money to save or to invest. So it all ties into the broader economic outlook and how the various institutions or the markets perform when it comes to consumption. So in a nutshell, let's give this a positive hypothesis that if consumption improves significantly, we should see the stock market continue to rally on the back of improved inventories and increased production. And also in the fixed income market, we should see investors tender in more bids to purchase most of the GOG bills and the treasury bills. That would then mean well for governments in terms of raking in revenue, and also mean well for the investor in terms of returns. So it all goes round. It all goes along ground to support the market if consumption improves.
Let's wrap up this way. So, what are the downside risks that could derail this growth trajectory, particularly in the context of fiscal tightening and, of course, global economic uncertainty?
Yeah. So yes, to some extent, I think we should link it this way. We should link it to employment, because as you create more jobs, people will then have wages, and as you create wages, they will then have more income to spend in that particular sense. if the proposed policies do not yield the benefit in terms of creation of jobs in the near future, then that will pose a major downside to the growth outlook that we are expecting. So those are some of the key things that we should pay attention to. There has been some quest to reduce the lending rate, but if the credit worthiness of the household consumer is not solid enough in terms of having good collateral to really back the loan that you are going for, or having any good credit standing in terms of past or even a good job that could even back their quest for a loan, it would then mean that they wouldn't get the loan that they actually need to expand. And then in the long run, that would defeat the whole purpose of an economic expansion. So I would say that we should look at it from the point of creating more jobs, considering the fact that the unemployment rate is still at very high levels.
All right.
And if we're able to do that, we'll mitigate the downside effect when it comes to growth expansion.
Economic and fixed income analyst at Data Bank Research, Wilson Jilevu, thank you so much for your time. Let's pause for a break. We'll be right back with more. Hello again, welcome back to Business Live. The growing refusal by traders to accept Ghana coins is creating daily financial stress for revenue collectors and disrupting small transactions in local markets. Speaking in an interview at the Malata market, revenue collector Amos Osesa Kodie says the rejection of coins by traders has made it difficult to spend legally issued currency, even though the same coins are passed back to government offices.
Since last year, I've been suffering with these coins because they gave it to me, but if I buy something outside, they don't collect. Even if I change to the market sellers, they say they don't like it. It's just a Malata market. Pure water people, those selling pure water at Malata, they don't collect. Those selling at Malata, they don't collect. But they give it to me. If they collect, they will give it to me and tell me that I'm working at the revenue office. So I'll send it to the bank. But if you send it to the bank reject it back. They give us back these coins because it's Ghana money. But I will beg you that they should let them collect the money. Those that refuse to collect it, they should at least be punished or they should be arrested so that they will know that it's not being rejected. It's Ghana money that we are using. You see, something like this Maggi that they are selling, they should remove it 1-1, but they've tied it 1 cedi instead of the small Maggi, because we have 2 types of Maggi. They have the big one and they have the small one. They can sell that small one even 30 pesos, so that if the person collects these coins, that person knows that if he's going to market, he use 30 pesos to buy Maggi. But due to the market people, they've combined it 1 cedi. So if you go and you give them 20 pesos, they say they will not collect because there is nothing that they sell it 30 pesos or 80 pesos again. So I will beg them that they should talk to the market people too, that things that is lower should come to their lower level so that they can use the 20 pesos.
And we know Ghana coins is still a legal tender. All right, let's go to myjoyonline.com/business for some quick read on that portal. Ghana reference rate for January drops to 15.68%. Interest rate set to decline. That's according to the Bank of Ghana. Also on that portal, Santihini cautions economic managers against complacency despite signs of stability. And of course, he visited the central bank yesterday and made that pronouncement. You can get more stories when you log on to myjoyonline.com/business. I am Pius Kojo Baka. See you at 8 p.m.